Z continues to decline as Sony calls off the merger, stock down about 27 odd percent, erases over 6,600 crore of market cap in trade today. Market extends fall, Sensex below the 71,000 for the first time in over a month, Nifty hovers around the 21,400 levels. Meanwhile, all sectors except pharma and IT in the red. Nifty Media remains the most beaten down sector, down almost 10% in trade. And for HDFC Bank, the pain continues. Stock falls for a fifth consecutive day, erasing market cap of over 4,000 crore, 24,000 crore in trade today. Meanwhile, Prime Minister Narendra Modi announces setting up a new scheme to electrify 1 crore households with solar electricity. Solar-centric stocks shine. Good afternoon and welcome. You're watching Market IQ here on NDTV Profit. Quick check on where markets are at. You're seeing weakness across the board. Let's quickly look at where the Sensex is. You're seeing a cut of roughly 1% or so on both the Nifty as well as the Sensex down. There you go. And what we're seeing is we're trading at the day's low as we speak. So that's the other piece. Now, with regard to what's dragging indices, you're seeing HDFC Bank, which is the key drag. 90 points is what HDFC is dragging the Nifty by, and down around 3 odd percent is where HDFC is, and closely followed by Reliance. That one is down by another 51 points, or rather 45 odd points. So on a combined level, you're seeing around 120 points of drag from only those two. You're also seeing Axis, which is dragging the indices by around 20 odd points. Mind you, results today, HUL continues to be the other one. In terms of the good performers in trade, you're seeing the likes of an ICICI Bank, which is definitely doing very, very well in trade. You're seeing it up around 2.5 odd percent. And let's take it to the Nifty Bank because that's where the action seems to be coming from. If you can pull up the Nifty Bank down around 1.7% in trade today, and within the constituents of the Nifty Bank as well, you'll see that largely the drag is coming from everyone except of ICICI, which has delivered a solid set. Let's also try and pull up the likes of a Kotak and see where that one is currently placed at, because it delivered a smooth set of numbers on Saturday. Mind you, but a lot of the gains were already clocked in on Saturday, and after that initial hold up, it seems to have slipped 1.2% lower. But we'll stick with the financials. We have Shalabh Saxena, who's of Spandana Sphoorty, who's going to join us now to talk to us about the company as well as the latest results. Welcome to NDTV Profit, sir.
Nice to be here, Hersh.
Right, sir. Sir, try and break down the number for us, especially with regard to, let me go specifically with regard to margins first off. There's been some amount of margin compression in this quarter. What's caused that, and how do you see margins to play out over the rest of this calendar year?
Sure. So let me start with the results and then I'll answer your specific NIMS question. Hersh, we are... the highlights of the quarter were that this is the first time in the history of the company that we've crossed the 10,000 crore AUM. We've ended the quarter at 10,404 crores. So that's number one. Number two, if you see the profit after tax for the 9 months, We are at 372 crores, which is a all-time high for the company, even if I compare it annualized. The annual PAT, the highest that the company has seen is 352 crores in about 3 years back. So in 9 months, we have actually tipped over the full year, PAT of the past years. As far as the other core model of the company is concerned, we are primarily a microfinance company. We started the last 7 quarters that if I see, one of the fundamentals was that we were focusing on customer acquisition. If you see our customer acquisition growth, it has been very robust. Last quarter, we acquired about 3.5 lakh customers. If you see the 9 months of cumulative aggregation, we are very close to 1 million customers acquired in the year, which is a very pretty strong number when it comes to core distribution of the company. So that's number two. Number three is when I look at the disbursements are in line with what we've been speaking to various people, the various external media people and folks like you. So over if I see the sense of direction, I think we are in line with what we had, what we had been saying all along in terms of be it the top line or be it the guidance on the quality front. Now, let me also explain the NIM part and then I'll cover the other part. If you see in NIM on a quarter-on-quarter basis, has seen a contraction of about 84 bips. Of the 84 bips, about 38 bips, and before I go into the negative minus 0.38, let me just explain that we as a company, Hersh, have been a monthly company in the sense that when we give a loan, the installments are collected monthly. Microfinance and a large part of the microfinance distribution model across the industry works on the weekly model as well. Nothing wrong in either of them. The only thing is that we as new management, when we took over about 7 quarters back, we had articulated that we would want to progress and go the weekly way and not the monthly way. So what we did was about 2 quarters back, a quarter and a half back, we moved to the weekly model from the monthly model. About 52% of the distribution was covered in this initiative. About 1.6 million customers were impacted because of this. And hence the flows that we see, the 38 basis points of flow in the contraction of the NIM that I'm talking about, is a result of the flows which otherwise should not have been, because what happened was it changed the whole dynamics. From dates, we moved to days, so slightly technical, but broadly speaking, we changed the distribution model. And hence, there was some bit of a disruption because of this. While we've we believe that, that is the right step and the right thing to do for the long-term sustainability of the company. And hence we walked that path. The other part, which is the 46 basis points, which comprises of the 84, is an increase in the financial cost. Let me explain. About a year back, we were geared or we were leveraged at 1.7 times, which now, if you see the last result, it is at 2.3 times. So as the leverage increases, you will see a contraction in the NIMs, and that is what has happened. That's the 46 basis points. You add the two, comes to the 84 basis points. But directionally, if I were to say, a leverage we've been stating that we are comfortable with the leverage of a sub of 4. Right now we are at 2.3, so still some headway there, where we'll kind of move. The transformation, the model transformation that I spoke about, we will take another 2 to 3 months to kind of just settle this. So at best, maybe the first month or a month and a half of the next quarter, I think we should be done with this major initiative of the company. I understand disruption, but as I said, long-term interests notwithstanding, we would want to kind of ensure that we create a robust model where it becomes a scalable model. And our comfort collectively is on the weekly model, and that's why we are moving that path. Our guidance has been, a NIM of upwards of 13.5%. ROAs of upwards of 4.5%. We've delivered a 5.5%, so that part is intact. Customer acquisition-led growth will continue. So broadly, this is what I want to explain in terms of the drop on the NIMs, the specific question that you asked.
Understood. Got it. Yes, and that makes a lot of sense because when I'm seeing your cost of borrowing, it's down just about 20 bips sequentially, which is, or rather almost 30 bips sequentially, which is definitely a positive, and hence the puzzle as to what's happened there. But thank you for that. Let me also try and understand from you. So 13.5 is the steady state margin which you're expecting. You're going to be in a rate cutting cycle, hopefully very, very soon, of course. Does that possibly leave you with a window for a larger expansion on your margin, maybe in FY25?
So Harsh, if you see our yields, we are upwards of 24, and we would, want to stay that way. In fact, we are looking, at passing some of the benefits. We were just waiting to see how the operating environment evolves and the repo rate and the RBI, whether it's going up or down. We were not very clear. So now it looks to be a reasonably, a steady state as far as the repo rates are concerned. So as an institution, we are looking at passing on some benefits of the, interest rates that we operate at to customers upwards of 6 cycles with us. So that is one step that we've already taken. In general, we anticipate, that is the range that we will operate in. Any NIM, any portfolio with a NIM of about 13.5 and above is what we will stay at. And given the stability in the environment, I think we will be happy to, and in fact we've already taken steps to ensure that the rate cycle is passed on to select customers.
Sure. Fully understood, Mr. Saxena. I'm going to try to tell you to keep your answers a little bit quicker because we're running short of time. Now, with regard to your NPAs, you've seen a bit of a spike on your GNPA. Talk to us about what's happening in the 1 to 60 DPD bucket, because that seems to be where this is originating.
Yes, so if you see the SMA buckets from 1 to 90, about 50% is in the SMA 0, which is the 1 to 30, and then you add another one, which is what you've said. This is essentially going back to the same point that I made, which is the transformation project from a monthly to a weekly and dates to day, which has led to this disruption. Another 2 to 3 months, I think, we should be done with it, and we would have then changed at least 50% of the model that we desire it to be.
Understood. And with regard to how you're going about with on your expansion of AUM, is there going to be a geographic expansion because you've guided for 10,000 to 28,000 by FY28? Does that also factor in newer geographies and hence newer risks?
Yeah, so beginning of, or rather 7 quarters back, which is FY23 beginning, we had said that, from a distribution point of view, we had identified 7 focus states, predominantly in the northern part of India, where our market share was about 0.2%, 0.3%, which is a pretty insignificant number. So we said, these are the 7 states that we are going to grow, and that is where we are. We are progressing very fast on that. Of the 7, we've dropped 1, which is Haryana, because of various reasons. But otherwise, 6 states is where we are going to grow. What this will do, Hersh, is to give a balance to the geographical spread that we have as a company. Microfinance is a business where you have to be mitigated when it comes to geographical expansion, geographical spread of your portfolio. And hence, we are saying we are going to, instead of just a southern piece, which we were east and southern part of India where we were present, now we'll have a really wholesome growth, which is the north part as well. End of this year, we had guided, or we had indicated that we will end the AUM anywhere between 11,500 to 12,000 crores. That's the rough number that we are looking at, with a maximum state contributing just about 14% this year.
Understood. Thank you so much, Mr. Saxena, for breaking that down for us. We are completely out of time, and we're going to slip into a very short break. On the other side, we have Virender, Jeet, who's the CEO at Newgen Technologies, and Vishal Mehta, who's the CMD at Infibeam Avenues, both of which on the other side. Stay tuned. Welcome back. You're watching Market IQ on NDTV Profit. We have with us the management of Newgen Software. Virender Jeet is joining us now to talk to us about numbers. Of course, numbers disclosed around a week or so back. But Virender, it's good having you here.
Thank you, and thank you, Hersh, for having me on the show.
Right. So talk to us about how things are evolving, because your margins definitely seem to have gotten better. Is this kind of a number sustainable from here, given the fact that OPEX has been softer this time around? And in the tech space, what are the trends that are playing out that are aiding this?
Well, Harsh, first of all, I'd like to, explain that we are a software product company, so slightly different from the rest of the Indian large great industry.
Sure.
So our both revenue cycles as well as how the market behaves for us slightly is different. And post-COVID, as the market opened, we have been on a growth curve, and I think we have significantly, in fact, enhanced our growth, which has been historically 20%. Now we are going more like about 25 to 30% of growth, and that has continued. And this momentum has primarily come from the markets where we have been traditionally strong, that is India, Middle East, Asia Pacific. While US market, we still continue to grow at roughly around 25% for 9 months, but still it lags our 30% growth. So it's still a strong growth, but not at par with the rest of the markets. See, what's working for us is, we are one of the unique companies which have got products which are globally recognized. And, the India product story has started taking shape, but we started building these products for the last 25 years. With the recognition now we have, the way the customers are responding to our products is really picking up. We have got huge traction on the banking space in digital lending, trade finance, and many other products. Similarly, on insurance, we have a huge portfolio. And the markets which are like India and Middle East, banking and insurance is a large spender of technology. And they have been slightly disconnected from the challenges which most Europe and US are facing right now. I think they're spending, and this is really sustaining our higher growth momentum. Where we are right now, we don't see any challenge why we can't continue that growth momentum. I think we don't see any headwinds in these markets. And while there is a hope that US and Europe starts recovering and we can build a stronger growth momentum out there. Margins is not an issue for this business because we are a software license business, almost generating 65% gross margins. A lot of our revenue has got no direct cost because it's coming from licenses, ATS, subscription, SaaS, which is typically, which we build for future and invest in that. And so we do have kind of an understanding that we can easily deliver roughly around 19% of net margins and 23% of EBITDA margins. And I don't see any challenge doing that in next quarters. The business is slightly seasonal, so Q1, Q2 is slightly smaller than Q3, Q4. That's why the margin position looking at quarter basis may not be fair way of looking at it. So sometimes they are much lower in earlier quarters. So they will keep on expanding in the Q3 and Q4. But at the annual level, you'll always see that the business delivers very healthy margins.
Sure, understood. And with regard to revenue growth itself, around 60% of your revenue is annuity. Where does this go? Would you rather focus on that business where you have a slightly higher base, but your growth has been quite solid, 20% plus? How will the mix emerge eventually, maybe 3 years from now?
So Harsh, as part of product business, what is happening, it's the nature of the business that business has got kind of a compounding of annuities. Because whenever you sell license, there's a kind of compounding of any ATS or subscription businesses follow that. Similarly, subscription-based licenses have kind of an annuity. So as you grow in size, the annuity part of your business keeps on growing. So I'm very hopeful that once our business reaches a threshold of roughly around 300, 400 million, we should be almost generating 70% of annuity. This is not what we focus on, but this is the function of the business as the business evolves. And as our implementation and services are more centered over partner ecosystems, the license part, the higher gross margin part of the revenue starts growing faster than the rest of the revenue.
Right. My last question is with regard to your customers itself. Your customers have virtually doubled in the last 2 years, which is, extremely, impressive to say the very least. Where does it go from here? Would you rather much focus on the current cohort, or would you be going out and hunting for more?
So we have not really doubled on customers, but I think we have got excellent new logo acquisition, and that's part of, again, as part of product companies, for our growth, new logo acquisition will always remain very, very important. So while our deals are becoming larger and our existing accounts are generating almost 90% of the next year's revenue, with almost getting a higher revenue retention rate every year, we will still focus on new logo acquisitions because our aspirations are really to grow much higher. So acquisition of logos in mature markets is going to be one of the key things. So it's going to be a balanced approach. There's going to be a lot of upside in all the accounts we enter because these are generally large enterprise accounts and our business is very, very sticky. But on the other hand, new logo acquisition is very important for long-term growth of the company.
Sure. I apologize. I stand corrected there. Your base of customers where revenue exceeds $50 million has doubled. So that's the piece that I was looking at. Fair point. Thank you so much, sir. It's been a pleasure interacting with you. Completely out of time on this one.
Very much.
So we'll let you go on that note. Thank you so much.
Thank you.
Right up we have Vishal Mehta of Infibeam Avenues also joining us. Vishal, talk us through the numbers because, with regard to margins, how do you look at the margin number? Because when I was looking at the margin number, it was seeming that you calculated on a net revenue basis. So how should one look at your margins in this quarter?
Sure, Hersh. So basically, we are a payment processor. We own a brand called CC Avenue. So when you make an online payment, we would take the payment from the customer and give it to the merchant. And we earn a very small fee in every transaction. So since there are multiple payment options, a customer can pay by credit card, debit card, UPI, net banking. The gross revenue that we collect in each of these payment types is different. And what we do is we net out and we report something called the net revenue, which is after we pay the payment gateway charges, whether it is to Visa, MasterCard, whether it is to the banks. And as a result, what we do is we compute the EBITDA margins based on net revenue. Net revenue is actually what we get after we pay all the payment providers or in the ecosystem. So if you look at our quarter, in terms of net revenue, we netted about 112.8 crores in Q3 of this year. And if you look at year-over-year performance, last year we have increased that by 33%. So while the transaction processing volume, say for example in UPI, we don't record any gross revenue. But in something like a credit card, we would report 1.6, 1.7% in terms of gross revenue. While the net revenue is what we get after we pay all the payment providers. So as a result, when we look at EBITDA, that's what we look at, which is what is the net revenue. And if you look at the 9-month performance, we have clocked 322 crores, which is about 36% higher versus what we reported in the last year.
Point taken, sir. So, with regard to the business itself, everyone knows CC Avenue because we all do online transactions. Talk to us about what, of course, the growth potential is immense, but what is the kind of number you're looking at 2 or 3 years from now in terms of top line?
If you look at our performance for the last 1 year, last year we clocked about 2,000 crores in revenues. This year we are targeting 3,500 crores. If you look at year-over-year performance in terms of our revenues, it's grown 120%. Of course, Q3 being a seasonal quarter because we have a lot of travel, hospitality, everything that plays a role. And also we add about close to 250,000 merchants every quarter. So that's a significant increase in terms of what we do versus what we did last year. So if you look at our projection for this year, we are expected to hit 3,500 crores in terms of revenues. And we're expecting profitability to be close to 150 crores. I think we'll be in the upper range of our guidance for this year, given our performance for 9 months and also the performance this quarter so far. If you look at the next 1 or 2 years, we have guided the street saying by FY26, we would like to reach $1 billion, which is about 8,200 crores in terms of revenues. So I think if we are able to perform what we did in the last 1 or 2 years, I think we should be on track to achieve that guidance for 26 as well. And that will be a combination of adding additional merchants. If we are adding more than 1 million merchants a year, that will continuously help us in terms of increasing the amount of transactions that we process. We've also introduced a framework called Tap Pay. So if you look at, Mumbai, the Chalo service, the Chalo bus service, when you actually go and tap your card, it's helping about 2.5 million passengers on a daily basis. So that goes through us. It is, allowing merchants to accept payments across debit card, credit cards, and many other payment types without actually investing into point of sale device.
Sure.
So while India is, very active in I think, in terms of the number of kiranas and many others who are expected to increase as well as local commerce increases, we believe that giving this tap-pay solution will help.
Sure, very interesting trends with regard to payments, Mr. Mehta. But I'm going to have to let you go on that note because we're completely out of time. But I'd love to have a separate chat with you, and we'll call you for that. But that's all we have on the show for you today, viewers. Thank you so much for staying tuned to NDTV Profit. Continue to stay tuned because more, of course, on the other side.